Imagine buying a luxury apartment in literally the most prestigious zip code in Singapore.
Right.
You pay top dollar, assuming it's basically the safest investment on earth.
Right.
But then you fast forward a few years, and you are watching that exact property bleed $1 million in value.
Yeah, it's brutal.
And while that's happening, a standard family home out in, the deep suburbs has literally doubled in price.
Which sounds completely counterintuitive, doesn't it?
Completely. And it isn't some wild dystopian hypothetical. That is exactly what we're seeing in the data crossing our desks right now in week 18 of 2026.
Yeah, I mean, for decades, the unquestioned golden rule of Singapore real estate was the location premium, right?
Mhm.
You buy a prime property in District 9 or the CBD, you just hold it, and the wealth accumulates. It was treated as like an unshakable law of physics.
Okay, let's unpack this, because if you're looking closely at the intelligence right now, the physical law is just breaking down.
Yeah, totally.
The old rule book isn't just being revised, it's being thrown completely out the window.
Yeah,
So welcome to this deep dive.
absolutely.
We are bringing you a highly curated, data-driven briefing tailored specifically for you. Whether you're an expat relocating your family, a high net worth buyer, family office director, or just an investor tracking Singapore's prime luxury market.
Our mission today is to basically act as your private market intelligence team. We're going to examine the core central region, or CCR, the evolving expat rental scene, and the absolute apex of the market, which is good-class bungalows.
Right.
But more importantly, we want to look underneath the headline numbers to solve a mystery. Why is the oldest rule in Singapore real estate dying, and, well, what's replacing it?
I love framing it that way because if you just glance at the surface, things look deceptively stable.
Yeah, they do.
Let's start with the immediate everyday impact of this shift, specifically in the expat rental market.
Definitely a hot topic.
If you're an expat tuning in or you manage corporate relocations, you need to listen very closely to this part, because the era of the desperate tenant paying peak 2023 rents is officially undeniably over.
What's fascinating here is that the headline numbers are masking this massive structural shift underneath. Let's actually put some numbers to that reversal, because the correction is stark.
Yeah, give us the benchmarks.
We're seeing a distinct normalization after 3 years of brutal supply shortages. So if we look at the CCR right now, a standard one-bedroom luxury condo has dropped from a peak of $5,500 a month down to around $4,500.
Wow.
And 2 bedrooms, they're down from $9,000 to roughly $7,200 a month.
It's just a staggering drop. I mean, I remember the horror stories from 2022 and 2023.
Oh, yeah, it was wild.
Trying to secure a decent two-bedder in River Valley back then, it was just a nightmare. It was like begging for a table at a fully booked Michelin star restaurant. You'd show up to a viewing with 20 other people. You took whatever shoebox they gave you at whatever exorbitant price, and you essentially thanked them for the privilege.
Yeah, you really did.
But now, in 2026, you're the VIP guest dictating the menu.
Yeah.
The power dynamic is completely flipped. But let me push back a bit here, because numbers on a spreadsheet are one thing.
Yeah.
On the ground, are landlords actually yielding to these lower numbers, or are they just, being stubborn and leaving units empty rather than lowering the rent?
It's actually more of a high-stakes standoff right now. It's not that landlords are cheerfully surrendering.
Right.
Many who own those generic, older CCR units are refusing to adjust their expectations. And as a result, they are bleeding cash through extended vacancies. They're playing a game of chicken that they are mathematically losing.
Because the tenants finally have options.
Exactly. The massive wave of supply completions from 2024 and 2025 has fully flushed into the market now. Tenants today have genuine leverage. And that leverage has triggered a massive behavioral shift. Think about the psychology here. If you aren't forced into a panic signing, you start evaluating what actually improves your quality of life.
Which brings us to what expats are actually demanding in 2026. From the notes we're reviewing, they're completely over the generic CBD address. Living in a tiny box next to a skyscraper just isn't a flex anymore.
No, it's a liability. Expats are prioritizing green surroundings now. They want larger spaces. I mean, a spare room for a home office is now viewed as an absolute necessity for hybrid work, not some luxury.
Yeah, absolutely.
And most importantly for families, proximity to international schools is entirely trumping proximity to Orchard Road.
That makes total sense, and it perfectly explains why the rest of Central Region, the RCR, the city fringe, is suddenly hitting this incredible value sweet spot.
Right. The numbers there are really interesting.
Yeah, the data shows a city fringe two-bedroom is now leasing between $4,500 and $6,500 a month. You get the space, you get the family-friendly community vibe, and you're still, what, 15 minutes from the office?
Yeah, exactly. The expat tenant of 2026 is highly sophisticated.
Right.
They're price sensitive, they know the supply data, and they know they have the upper hand. So if you are renting or your lease is up in the next 6 months, you have a strategic imperative to act right now.
Wait, if the supply is so high and landlords are bleeding, why the urgency? Why not just wait and see if rents drop even further?
Because the window of peak leverage is closing.
Oh, really?
Yeah, we're projecting that corporate relocation demand, particularly from family offices and the financial services sector, is going to pick back up significantly in the second half of 2026.
Oh, okay.
Right now, in week 18, landlords with empty units are highly motivated, perhaps the most motivated they've been in 3 years. You need to use that. Push for a 2-year lock-in at these current lower rates.
Right.
Demand minor furnishing upgrades as a condition of signing, or, ask for a month rent-free before the market tightens again.
That is incredibly actionable. Do not wait for the corporate hiring mandates to ramp up and flood the market with competing expats again. Lock it in now.
Exactly.
But this natural pivot brings us to a much darker side of the coin. If expats are successfully renegotiating rents downward and demanding larger spaces outside the core, what has happened to the owners of those prime, older CBD properties?
Well, this is where we get into the CCR identity crisis, and it answers that mystery you posed at the very beginning of our deep dive. We basically have to separate the prime market into two completely different realities.
Here's where it gets really interesting. The losses being booked on older leasehold CCR condos right now are eye-watering.
They really are.
The sources name specific projects taking million-dollar hits. The Clift, Marina Bay Suites, OUE Twin Peaks, Marina One Residences. Buyers who bought at previous peaks are just hemorrhaging capital.
To understand the scale of this underperformance, look at the 15-year growth data from 2010 to 2025.
Okay.
Over that decade and a half, CCR prices grew by only 18%.
Just 18% in 15 years.
Yeah, and over that exact same 15-year period, the outside central region, the OCR suburbs, grew by 45%, and the city fringe RCR grew by 55%.
Just let that sink in for a second. The most prestigious elite addresses in the country were outperformed by the deep suburbs by a factor of more than 2 to 1.
Pretty wild.
But wait, I'm looking at the rest of this data, and this makes zero sense on the surface. While those older leaseholds are booking million-dollar bloodbaths, the new CCR launches are setting absolute records.
Right, the divergence is crazy.
Yeah. The new launch pipeline for 2026, places like Newport Residences or the upcoming Denern Road Turf City project, they're averaging $3,208 per square foot. And Union Square Residences just hit a record $3,828 per square foot. How can $1 million loss and a $3,800 per square foot record exist in the exact same zip code?
I'm so glad you brought that up because the mechanics behind that contradiction are the most fascinating part of the 2026 market. It really comes down to two structural forces that are systematically reshaping buyer behavior.
Which are?
The 60% additional buyer's stamp duty, or ABSD, and the brutal mathematics of lease decay.
Okay, let's break those down. Let's start with the ABSD. Because historically, the CCR's premium was essentially bankrolled by foreign wealth, right?
Precisely. At its peak, foreign buyers accounted for 14% of all CCR sales. They loved those, 500 square foot, one-bedroom units in the CBD.
The classic investor boxes.
Exactly. It was a perfect low-maintenance pied-à-terre or just a simple place to park capital. But then in April 2023, the government hiked the stamp duty for foreign buyers to an astronomical 60%.
Which doesn't just deter buyers, it completely destroys the math of capital appreciation.
Yeah, yes.
If you pay 60% tax on day one, the property has to appreciate by 60% just for you to break even. Nobody's making that bet.
Nobody. The result was immediate. Foreign buyer participation dropped from 14% down to about 5 or 6%.
Wow.
That entire buyer pool, the people who used to reliably buy small prime units, was structurally removed from the market overnight. So you have to ask, who stepped into that vacuum? Who is the new buyer propping up the CCR today?
Well, it has to be local money.
It is. The new buyer is the affluent Singaporean family or the highly capitalized HDB upgrader who is cashing out of $1 million public housing flat.
And here's the light bulb moment. A local family of 4 does not want a 500 square foot one-bedder in a 15-year-old CBD tower. It is completely useless to them.
Exactly. They demand proximity to elite primary schools, usually within a strict 1 kilometer radius for the enrollment ballot.
Right.
They demand larger layouts. They need 3 or 4 bedrooms, enclosed kitchens, family amenities. That shift in the buyer profile renders the old investor-grade leasehold one-bedders virtually obsolete to the domestic market.
Okay, but let me play devil's advocate for a second.
Sure.
If those older CBD units are dropping in price so much, shouldn't they eventually become massive bargains? Why aren't savvy local investors swooping in to buy them up at a discount?
Because of the second structural force, lease decay, and specifically how banks treat lease decay.
Okay, explain that.
This isn't just about the psychological fear of a ticking clock on a 99-year lease. It's about the hard math of your purchasing power.
Walk us through the mechanics of that. What actually happens at the bank?
So, as leasehold properties age, particularly once they cross that 20-year mark, banks start applying loan-to-value, or LTV, haircuts.
Okay.
Normally, a buyer might secure a 75% loan on a property. But for an older leasehold, the bank might only be willing to lend 60% or even 50%.
Oh, wow. So if the bank lends less, the buyer has to come up with the difference in cash.
Yes. If you're trying to sell a 20-year-old leasehold unit for $2 million and the buyer's loan is slashed, they suddenly need to pull together hundreds of thousands of dollars in extra upfront cash.
That's a huge barrier.
Massive. Most local upgraders simply cannot secure the financing to buy your unit at your asking price, even if they want to. Your pool of eligible buyers physically shrinks.
That is terrifying if you are an owner. So translating this into a strategic imperative for you, the listener, if you currently own an aging leasehold CCR unit and it does not have a primary school within 1 kilometer to anchor that domestic family demand, you need to audit your bank LTV position immediately.
Without a doubt.
You need an exit strategy before that lease decay haircut prices you out of the secondary market entirely.
I would absolutely agree with that urgency. But conversely, if you are a buyer, this structural shift has created a historic generation-defining opportunity.
How so?
Because of the rapid price growth in the suburbs we mentioned earlier, the price gap between the prime CCR and the city fringe RCR is currently at a record narrow 10%.
Oh, right.
Yeah, it's averaging around $3,208 per square foot for prime new launches versus $2,695 for the fringe.
A 10% gap. I mean, that is basically negligible when you're talking about multi-million-dollar assets.
It really is. For a local upgrader, paying just a 10% premium to jump from the fringe into a prime district 9 or 10 address is a highly compelling proposition. It's essentially the democratization of the core central region.
Yeah.
But again, they are buying the new layouts, the larger family homes, the units built for living, not those old investor boxes.
Which leads us to a really fascinating question. If the smart money knows these older leaseholds are a sinking ship, where exactly are they parking their immense capital to avoid this depreciation? Because wealthy investors aren't just sitting in cash.
Right, they are seeking permanent value. We are seeing an aggressive, almost desperate flight to quality. Capital is migrating away from the compromised assets and concentrating heavily on large format freeholds, and of course the absolute apex of the market, good class bungalows or GCBs.
Let's talk about freeholds first. The data we're looking at highlights extreme scarcity. Try finding a newly built, large-format freehold unit, meaning anything over 2,400 square feet in District 9 today. It is incredibly difficult.
Yeah, and the few that do trade at significant premiums. The sources noted a conserved freehold terrace at 124 Karen Hill Road, currently listed for $16 million.
Wow.
And in the condo space, someone just netted a massive $5.2 million profit on a 5-bedroom unit at Leiden Residence.
A $5.2 million pure capital gain. That proves that patient, long-term capital deployed into prime, large-format freehold assets still yields exceptional returns.
It definitely does.
But if we want to talk about staggering numbers, we really have to look at the GCB market. In 2025, there were roughly 36 good-class bungalow deals, totaling $1.36 billion.
And we should clarify, that's just the caveats we know about.
Right, right.
For those unfamiliar, a caveat is basically a legal claim lodged with the authorities when a property is bought, which gives us public pricing data. But in the GCB space, a significant portion of these deals happen entirely off-market without caveats lodged immediately to protect the privacy of ultra-high net worth families.
Of course.
So the real transaction volume is likely much, much higher.
Even with just the public data, the crown jewel of 2025 was unbelievable. The Pierce Road transaction. We are talking about an 80,448 square foot freehold site that sold for $148 million.
Incredible.
That's $1,840 per square foot, strictly for land. And then we saw the government award the Phoenix Park site on Tanglein Road to TS Home, which signals deep institutional confidence in these ultra-premium enclaves. When I look at this GCB market, the traditional metaphors fail. You're no longer just buying a place to sleep. You're buying a Picasso.
That's a great way to put it.
It feels less like real estate and more like buying a corporate vault. So what does this all mean?
Well, I think corporate vaults is the perfect analogy. If we connect this to the bigger picture, you aren't looking for yield, right?
Right.
You aren't buying a $148 million property to rent it out and make a 3% return. You're buying it because it's a fortress. It's about legacy, extreme scarcity, and capital preservation. You want a place where inflation and lease decay simply cannot touch your wealth.
Yeah, that vault mentality explains the clear bifurcation we're seeing in the GCB market right now.
Exactly. The mid-tier GCBs, those smaller plots on the fringes of the designated areas like Caldecott Hill or Chestnut Avenue, are actually moderating a bit.
Really?
Yeah. Supply is entering, and sellers there are having to adjust their expectations. But the top-tier trophy plots, anything over 20,000 square feet in prime areas like Nassim or Pierce Road, are holding incredibly firm.
Why is the top holding so firm while the middle softens?
Global wealth flows. Singapore is now home to over 120 massive family offices. Amidst global geopolitical uncertainty, ultra-high net worth capital views these massive freehold Singapore plots as generational safe havens.
Right, they trust the system here.
They trust the regulatory environment here more than almost anywhere else in the world. And remember, a key financial shift happening right now, we are moving into a declining interest rate environment.
How does that affect buyers who probably pay in cash anyway?
Well, even billionaires use leverage to optimize their capital, and declining rates help restore positive carry. Normally, the cost of borrowing money to buy a GCB is higher than the tiny rental income it might generate, creating a negative carry. But as interest rates drop, the cost of holding these massive assets decreases significantly. That changing math only emboldens these institutional-level buyers further.
It's a completely different stratosphere of buying behavior. The motivations are totally divorced from the typical property cycle of buy low, sell high.
Exactly. They aren't asking their private bankers about rental yields or short-term flips. They're asking, will my great-grandchildren own this piece of land in a century?
Okay, we have covered an immense amount of ground today. Let's bring this all together and recap the actionable takeaways for you from this week's intelligence briefing.
Let's do it.
First, if you're an expat renter or managing corporate relocations, your strategic imperative is to recognize your leverage. The balance of power is yours right now. Push for 2-year lock-ins at current stabilized rates before corporate demand rebounds in the second half of the year.
Second, if you are an owner in the core central region, you need to coldly, objectively audit your asset. If you are sitting on an aging leasehold without a primary school or an MRT anchor, evaluate your exit strategy right now.
Yes, act fast.
Do not wait for lease decay LTV haircuts to shrink your buyer pool even further.
And finally, for buyers, family offices, and investors, the record narrow 10% price gap between the CCR and RCR is a generation-defining entry point. But target your capital wisely. Avoid the obsolete shoeboxes. Seek out the large format freeholds and the trophy assets that offer permanent, undepreciating value. Which brings us perfectly back to the mystery we started with.
It does, and it raises a thought I want to leave you with today.
Okay.
For decades, the premium of Singapore real estate was strictly defined by geography. It was a literal map with a red dot in the middle. How close are you to Orchard Road, or how close are you to the CBD? That was the ultimate, unquestioned metric of wealth.
Location, location, location.
Exactly. But look at the evidence we've just unpacked. Decentralization is taking hold, moving employment hubs to Jurong or Punggol. The foreign buyer, the main patron of the CBD box, has been taxed out of the market by the 60% ABSD. And local buyers are prioritizing schools and space over downtown addresses. We are witnessing the death of the location premium and the birth of the utility premium.
The utility premium, meaning the value is derived entirely from what the property actually does for the family living in it.
Exactly. Let's think about the future. Will the most expensive, highly coveted addresses of 2036 be defined by their central zip code? Or will they be defined strictly by their proximity to elite primary schools, their sheer square footage, and their freehold tenure, regardless of whether they sit right next to the CBD?
It's a great question.
The data suggests the market is deciding that answer right now.
That is a brilliant lens to view the market through. The old rulebook of Singapore real estate truly is being rewritten, and utility might just be the new location. Thank you for joining us for this deep dive. Keep questioning the headlines, keep looking beneath the surface of the market numbers, and we'll see you next time.